All right. So I'd like to take this opportunity and discuss question number one on your chapter seven homework. Some of you are asking for a little video help. All right. So this is about the financial planning model, and we're going to solve this financial planning model and apply this to value this company called Yummy Company. It makes very special tomato sauce. Tomato sauce is very healthy. So first of all, let's make sure our Excel is properly configured. So just make sure you need to check the box for enable iterative calculation because we're going to use this feature to solve the financial planning model. And my workbook calculation is also set to automatic. All right. So my Excel is actually properly configured now. And let's look at the value driver assumptions. So I'm just doing this for illustration, and you don't have to do it this way if especially if you're really comfortable with the financial planning model. All right, sales gross, and that's going to be 12%. Okay, this is straight from the question, and you have current assets. All right, and that's going to be 22% of sales. All right, and you have current liabilities. All right, and according to the assumption, that's 20% of sales. Okay, and then you have net fixed asset, right? Net fixed asset growth rate. So this is now a little different. In our in-class discussion, we mentioned net fixed assets, they are a percentage of sales. But in this particular question, net fixed asset growth rate is actually 5%. So it is not based on percentage of sales, but it's actually growing based on whatever starting net fixed assets you have or you observe. All right, and then you have cost of goods sold, and this is a percentage of sales, and this is actually 45%. All right, and then you have the depreciation, which is actually annual depreciation, and the depreciation rate is actually 20%. Okay, it's 20% of the average fixed assets at cost. Right, so interest on debt, all right, and then interest on cash. Well, actually, not interest, but interest rate. All right, so I should be a little more rigorous. Interest rate on debt, interest rate, on cash. All right, so the interest rate on debt is 8%. The interest on cash is 4%. All right, and you have tax rate here. So this is actually 36%. And you also have the dividend payout ratio. Okay, this is actually 25%. Okay, and then you have the sales. We're going to use sales later on. You also have the weighted average cost of capital, 16%. The long run free cash flow growth rate, this is 4%. All right, so this is a value driver assumption. And somewhere here, you should realize that financial policy assumption. We're saying these are two sets of assumptions. Okay, and let's look at, first of all, let's look at the income statement. All right, and so we're going to look at year here or period here. All right, period is 0. This is what we observe, and we're trying to project into the next 5 years. All right, so I'm going to actually make this 0, and this is 1 period from today, and I'm going to have 5 periods here. So let me just copy this across. These are all showing as percentage. So I need to bring back my ribbon and show this as a number here. All right, so number, and let me cut the decimal so that it's 5 periods here. Okay, and the first thing is sales. All right, so for the observing period, the sales is actually, this number is actually, I don't know what this number is, but let me just copy this number from the question. So I have 2 screens here, and I'm moving my mouse to the other screen so that I can just copy this number for sales. Sales is this number here. Press Control C and put it back. Control V. All right. Um, and you have cost of goods sold, which is actually 45% of sales. So I'm going to look at what's going to happen in year one. In year one, you're going to actually have starting sales multiplied by 1 plus the sales gross. Okay, so let me lock down the sales gross. So that's the sales. And now I'm seeing 45% of that is actually the cost of goods sold. So let me just model that. Okay, all right, that's the cost of goods sold. And then you have the next item is, so we're looking at income statement. So the next item is annual depreciation. Okay, annual depreciation is actually the depreciation rate times the average fixed assets at cost. So let me actually move down to the next item here because I need to find what is the row I'm going to dedicate to fixed assets at cost. So let me just skip here for a moment. Next item here is the so you have a cost of you know, you have sales, you have cost of goods sold, you have annual depreciation. So you're going to get essentially profits before tax, okay? And then you're going to pay tax. You're going to have profits after tax. And then you're going to pay dividends, and then you're going to have retained earnings. Okay, so these are the standard items you have seen. All right, so that is the income statement. And now I'm going to look at the balance sheet. All right, so the first item on the balance sheet is cash. Okay, and the second item, well, this actually is the asset side. All right, so then you have current assets and you have fixed assets. Okay, so we know there are three kinds of items or elements on the fixed assets, which is the fixed assets at cost. So that's one. That's the total fixed assets. And then you have the total depreciation. Okay. And then you have the net fixed assets. Okay. So that is the asset side. So now we can actually look up the total assets. Okay. Again, this is a simplified company. So the balance sheet is actually very straightforward. And now let's look at the current liabilities or the liability plus equity side. All right, current liabilities, and then you have the debt, and you have the equity, and you have the accumulated retained earnings, and then you have essentially total liability plus equity. Okay, all right, so that is our income statement and the balance sheet. All right, these are the scaffolds of this building here. All right, so let's look at the annual depreciation. We know we should focus on the formula right here. All right, the numbers are going to be back alive once we actually solve this model. Okay, you notice that I'm not even worried about what we observe in the first period unless I have to actually dig out some items I need to calculate. So the annual depreciation is going to be the annual depreciation rate. I need to lock this down, multiplied by the average fixed assets at cost. So I need to look at where are the items for my fixed assets at cost. It's right here. So that's the fixed assets at cost for year 0. And this is year 1. All right, and divide that by 2. Okay, of course, we're going to get 0 because there's nothing in those two cells. All right, so the profits before tax is going to be sales minus the cost of goods sold minus the annual depreciation. All right, so and then we're going to pay tax, which is actually this multiplied by the tax rate. All right, so let me lock down the tax rate. And then the profits after tax is going to be the profit before tax minus the tax. Okay, now let's actually start paying our shareholders. So this amount multiplied by the dividend payout ratio, that's going to be the dollar dividend you're going to pay out. And so the remainder goes to your retained earnings. All right. So that is your income statement for year one. All right. Now let's look at the balance sheet. So the balance sheet. So in this question, if you look at the question, it says, cash is the plug. All right. So let's put this down. Cash is the plug, which means we're going to solve cash in the final step. Right. And it also says debt repayment. All right. It's actually $300,000 every year. Okay. 300,000 per year. All right. And so that is the financial policy assumption. What about equity? It doesn't say, so equity remains the same. All right. So that's the financial policy assumption, and this is the value driver assumption. Okay. All right, so let's look at cash. Cash is the plug, so I'm going to skip this. I'm going to look at current assets. According to the question, current assets, that's actually 22% of sales. Let me take sales. Let me do 22%, and that's the 22% there. So let me just lock down the 22%, right? Now the fixed assets at cost. So we need to actually look at fixed assets at a cost. So this is actually given. So I need to go to my word or question and copy those numbers. So fixed asset cost, that's this number here. All right. So this is actually for year 0. And the total depreciation, that's this number here. So let me put back the numbers into the question. And net fixed assets, that's this number here. So that is the net fixed assets for year 0. All right, so now I'm going to look at net fixed assets. Here, net fixed assets is actually based on the growth rate. It's not based on the percentage of the sales. So I'm going to take the previous net fixed assets and do multiply that by 1 plus the growth rate for net fixed assets, which is this number here. Right, and I need to lock down this number here. So I have this net fixed assets, and the total depreciation is going to be what you have depreciated as of year 0 plus what you're going to depreciate in year 1. All right, so this is the total depreciation. All right, and I know the total fixed assets or the fixed assets at the cost is going to be the depreciation, total depreciation plus net fixed assets. And you notice that the numbers, they have changed already, and Excel has finished at least one round of iterations. All right, so I have the, asset side, the only thing that is not known is the cash. I'm going to solve cash later. So let's look at the current liability. Current liability is actually, according to the question, it's 20% of the sales. So let me just do 20%, right? Lock down the 20%, multiply that by the sales, okay? So that is the current liability. And debt, well, debt is actually repaid per year. Every year they're going to pay off 300,000. So let's look at the total debt here. The total debt, I need to actually move my cursor to the question and to put down the numbers here. All right, so the debt repayment is going to be 300,000. So that means the debt in year 1 is going to be the debt in year 0 minus 300,000. Okay, all right, so that is the debt. And if you're just looking at 5 years, I can actually copy across. So, excuse me, this is year 0, 1, 2, 3, 4, 5. All right, there we go. So we model all the debt for all the other years. So I'm flying, I'm dancing around for, different years versus within the same year. All right, equity. So let me take the number for equity. That's 750,000. Okay, 750,000. We put down equity here. All right, so it's going to be the same. So that's going to be the equity for year 1 to 5. All right. So the accumulated retained earnings. So let me take that number from the question. All right. So, and now I can look at what is the total accumulated retained earnings for year 1. So that's going to be equal to what you have accumulated as of year zero plus what you're going to retain for year one. All right, so that is going to be your uh, total accumulated retaining earnings. All right, so now if you look at total liability plus equity, so that's the number here. All right, so now I'm going to solve this model here. All right, so we know that you're making all kinds of assumptions about the assets and the liability or equity side. So your balance sheet may not be balanced. So we need to prevent that from happening. And the way we do that is we manually balance the balance sheet. So we would set the total asset equal to total liability plus equity. And from that, let's actually, I just realized that we actually ignore the debt and the cash. So I'm going to fix that in a second. But let me pretend as if we're still on the right track. Okay. So I'm going to actually solve cash. All right. Actually, let me pause here for cash. Let me actually insert one more row here. Okay. Let me insert another row here. All right. So this is going to be interest payment on debt. All right, and this is going to be interest earned on cash. Okay, all right, so let's look at interest payment on debt. So according to the question, you're earning 4% interest on the cash balance. All right, so the cash balance. So what is the cash for year zero? Well, that's the number here. So let me put down this number here. All right, so that's the cash that's observed. So I'm just taking the number and putting it down for year zero. And now let's look at interest earned on cash. Interest earned on cash is going to be equal to the interest rate on cash, which is the 4%. I'm going to actually lock down the 4%. And this is actually an average cash balance. So I'm going to do the cash for year zero plus the cash for year one. There's no cash for year one. So it's just going to be focusing on the correct formula at this point. All right, so that is the interest earned on cash. And now let's look at the interest on debt. The interest on debt is going to be 8% interest rate you're paying. So we lock down the 8%. And this is also on the average debt balance. So I'm going to take the debt for year zero. I'm going to take the debt for year one. And let me divide it by 2. I get the average debt balance. And I'm paying 8% on that. All right. So now my profits before tax should be adjusted. I should do 1 minus the, except not 1 minus the sales, minus the cost of goods sold, minus total depreciation, minus interest you're paying on debt, plus the interest you're earning on cash. Okay? All right, so that number is good. And we double check this number. This is actually the previous number, which is the profits before tax multiplied by the tax rate. So that's good too. This number is the difference. That's the profits after tax, okay? And this one is now dividends. So you're paying out that, okay? And retaining earnings, very good. So the income statement is good. Let me just double check all the numbers for balance sheet. This is my plot. I'm going to come back to this. Current assets, so that's going to be the sales multiplied by the percentage of current assets as sales. That number is good. And we look at this number here. So that's the summation of the total depreciation plus the net fixed assets. So that's good. We look at this number here. This is the total depreciation, which is the total depreciation for year one, which is the total depreciation for year zero, plus what you have depreciated over year one. All right, so that's good. So what about this? This is the net fixed assets growth rate. So that's good. Right, total assets, so that's equal to set equal to total liability plus equity, so that part is good too. Look at this. So this is the current liability percentage multiplied by sales, so that's good. And this is the debt, this is the equity, and this part is the total retained earnings. This is good, so this is good too. All right, so now I'm ready to solve cash. Cash is the total assets minus the current assets minus the net fixed assets. Okay, all right. So I solved cash, and this is now all good. So we just solved the financial planning model for year one, and I do not look at all the numbers for year zero. I just pick all the numbers I need. So current assets for year zero, you have a number, but we don't use that number because all that matters for us in year one is the current assets as a percentage of sales. So that part is good. All right. So now I'm going to copy all the numbers to future years. Okay. All right. All the numbers that don't make any sense. I'm going to copy these numbers as well. All right. So I have all the numbers now. And let me just verify this is actually good. So let me check my solution for chapter 7 homework, and I don't seem to have my solution at hand. So let me just keep moving. Okay, I actually found my solution here. So let me just move this away, and let me see whether the numbers are good. This is number 1. So let me just take the total liability plus the equity, and yes, this is good. All right. Now I can actually look at the free cash flows evaluation. So I'm going to build the timeline here again. This is for the valuation now. So this is one period from today, and I'm going to deal with the infinite timeline here. All right. And let's look at the free cash flows calculation. So first of all, we're going to start from the profits after tax. So that is the income statement. That's the number in row 23. And I can copy this to year 5. And now I'm going to look at, putting back depreciation, adding back depreciation. So the annual depreciation is going to be in the income statement, and that's in row 18. So that's C18, and let me copy this across, okay? And now I'm going to look at increase in current assets, okay? So that's going to be current assets in year 1 minus current assets in year 0. So now for that matter, I need to put back the current assets and the current liabilities for year 0 because I need to actually calculate the increase. All right, so current assets is this number here, okay? And let me paste this number. And the current liability is this number here. All right, I have 2 screens. I'm referring to the other screen. And this is the current liabilities. All right, so now I can actually look at the increase in current assets. So that's going to be current assets in year 1 minus current assets in year 0. Okay, so this is the increase in current assets. All right, so let's look at increase in current liabilities. So that's going to be equal to the current liability in year 1 minus the current liability in year 0. And I can actually copy these 2 across. So I have these 2 items now. And now the add back after tax cost of interest on debt. All right, so this is going to be, first of all, we're going to do this on after tax basis. So I'm going to do 1 minus the tax rate. The tax rate is actually 36%. So this is 36%. I need to lock these down, multiply that by the interest payment on debt. So that's actually in the income statement. So that's in row 19. So that is the after-tax cost of interest on debt. Okay. All right. So let's look at minus, or I should just say subtract after-tax cost of, or I should just say subtract interest on cash. All right. So I'm going to do again after tax basis. So 1 minus the tax rate, which is B11, and let me lock down B11, multiply that by the interest earned on cash. So that's in row 20. So that is the, all right, after tax interest on cash. All right. So now we're going to look at the free cash flows. So this is according to the definition. All right, so I'm going to look at the profits after tax, and now I'm going to put back depreciation. I'm going to do minus the increase in current assets plus the increase in current liabilities, all right, plus the after-tax cost of interest on debt minus after-tax cost of interest on cash. So that is going to be, did I miss any numbers here? Oh, yes, there's one item for fixed assets, the cost, which is actually capital expenditure minus depreciation or increase in net in fixed assets, the cost. So I need to actually put back this, right? Increase in fixed assets at cost, right? So this is going to be equal to the fixed assets at cost for year 1 minus the fixed assets at cost for year 0, right? So that term is there. So I'm going to copy across. And now I need to actually minus the increase in fixed assets at cost. Okay, so that is this number here, $27,346. And I can copy this to the right. And now you see there are some negative numbers. Are you concerned? Well, yes, you should be concerned if you're running this company, but from our perspective, we just want to finish the valuation exercise. All right, so let's look at free cash flow growth rate. And we're saying this free cash flow growth rate, according to the question, is going to be increasing at a long run rate of 4%. Okay, so we know it's going to stabilize at 4% starting from year 6 and onwards. All right, so I'm going to look at the free cash flows in year 6, which is the free cash flow in year 5 multiplied by 1 plus the growth rate. And yes, you're dealing with an even more negative number. All right, again, we're focusing on the valuation aspect of it. If you're running this company, of course, you should be very concerned. All right, so now let's look at the terminal value. Okay, so we know you can calculate the terminal value here in period 5 because the free cash flow growth rate stabilizes starting from year 6. So I'm applying the Gordon model here, and this is actually equal to WACC, which is actually, according to the question, that's actually 16%. 16% minus the long run free cash flow growth rate. So that's the terminal value. It's a very big negative number here. All right, and now you're going to look at the cash flow per period by applying the Gordon model. We cut the timeline from an infinite one to a finite one with only 5 periods. So last period of cash flow is just going to be the terminal value plus the last period of free cash flow. And I can copy to the left. And now I can actually say present value of each cash flow. So I'm going to do discounting here. 1 plus the 16% raised to the power of 1. All right, so this is back to chapter 2. And now I can actually get present value of all cash flows, which is actually the enterprise value. All right, so the summation of all this. Okay, so it is that negative number there. And now we can actually get, what are we getting here? All right, so do we have number of shares outstanding? Number of shares outstanding, yes. We actually have this information from the balance sheet, all right? So I'm going to get market value of equity, which is actually equal to enterprise value minus debt. So the debt is actually in year 0 plus cash, and the cash is also in year 0. All right, so that is the market value for equity. And now I'm going to say stock price per share. So that's going to be equal to the market value of equity divided by number of shares outstanding. This is actually provided in the question, so I'm going to refer to my Word document. I'm just going to copy this number for number of shares outstanding, and let me just divide this number here, and the price is negative $3.16. All right, so this really is a very poorly run company. All right, so that is our evaluation exercise, and this is part B is actually saying, can you actually do the sensitivity analysis of the enterprise value to the growth in sales? All right. So let me just do part B. Right. So sensitivity analysis of the enterprise value, which is this number here. Okay, maybe I should make this clear. Enterprise value. All right. And sensitivity of the enterprise value to the sales growth. So if I change the sales growth, would I actually change or see different numbers for enterprise value? So let me just put 10% here. And would the stock price change? Would the enterprise value change? Yes, it changed. So it looks like we're ready for this data table. There's a link, and we just verify the link. So I'm going to actually look at the sales growth. So this is only one dimension data table, all right? Sensitivity of the enterprise value only to the sales growth. So I'm going to look at a range of sales growth from 8% in increments of 1% and going all the way to 16%. This is arbitrary, and I'm just doing this for illustration purpose. And I need to actually look at the enterprise value here. So that is the enterprise value. Okay, so this is like the top left corner, except that now we're only dealing with one row. All right, you can also set up this data table in a column. So now I'm going to actually highlight everything and go to data, what if analysis, data table. And now I actually have the sales growth set up in a row, and that number is actually the sales growth. So that's the 10%, that's B3. And there's nothing in the column, so I'm just going to set that as blank. All right, click OK, and yes, we have all the numbers, and we have, so maybe I should change this back to 12%, and let's see whether we actually replicate our enterprise value here. Yes, that's the same number you see. Okay, very good. So part C. This is doing the sensitivity of the enterprise value to the WACC. So now I need to actually verify there's a link, all right? So I need to actually look at WACC. So let me just say, what is WACC? WACC is actually assumed to be 16%, all right? And I'm going to actually clean up the cell references here. So when I change the 16% here, my enterprise value should change, right? So that's what I'm trying to get at, all right? So the free cash flows for each period, they're fine. And we just need to look at the terminal value here, 16%. Let me clean up the cell reference. That should be B63, okay? All right, so that number is replaced by the cell reference. And so this is good. So now I need to clean up the discounting here. So that's the B63, and I need to lock this down. Okay. So this is the numbers don't change, but we have just made our modeling more robust. Okay. So that's the enterprise value. All right. So what if I change this to 15%? Okay. Very good. So the enterprise value changed as well. So let me change this back to 16%. Now I'm ready for my data table. So I'm going to actually set the WACC. Actually, I'm going to set the WACC in a column this time. All right. So I'm going to start from 10%. Okay, and I'm going to do 1% increment each time. All right, and I'm going to look at 10% all the way to. This is just for pure illustration, 18%. Okay, so now I'm going to use this corner here to actually look at the enterprise value. So I need to look at the enterprise value, and now I have I've stolen the formula, And now I can actually highlight everything and go to data, what if analysis, data table. So in this case, the row input cell is going to be empty. The column input cell is going to be the WAG. Okay, let's click OK. And we should actually see this number here. That's what we saw from the part A, right? So this is all done, all right? So this actually is 35 minutes long. This is because it's actually a very lengthy process of completing all the major steps, all right? I hope this is useful.